Crash recovery strategy: how to double your money in crypto. Crypto news. Cryptocurrencies are a new investment class with limited historical data for fundamental research. Here are some things to consider before diving into this high-risk, high-reward world. Investors who have lost a significant amount of money in stock positions have three options: sell and take a loss, stay in hope, or double down. The hold and hope method requires the stock to return to your purchase price, which could take a long time, if at all. The double down technique is throwing good money after bad in the hopes of outperforming the stock. Fortunately, there's a fourth approach that can help you fix your stock by lowering your break-even point while reducing your risk. This video will go through that method and how you may apply it to your losses. One simple way to explain the strategy is that for every 100 shares of stock owned, the repair strategy is developed by purchasing 1 call options and selling 2 call options. Because the premium from the sale of 2 call options is sufficient to pay the cost of 1 call options, the outcome is a free option positions that allows you to break even on your investment considerably faster. Assume you purchased 500 shares of a business at $90 not long ago, and the stock has now plunged to $50.75 following a disappointing earnings report. You feel the worst is behind the company and that the stock will recover over the next year. But $90 seems like a lofty goal. As a result, your primary concern is breaking even as soon as feasible rather than selling your stock at a significant loss. In these situations, constructing a repair strategy would involve taking the following positions. Purchasing 5 of the 12-month $50 calls. This gives you the right to purchase an additional 500 shares at the cost of $50 per share. Writing 10 of the 12-month $70 calls. This means that you could be obligated to sell 1,000 shares at $70 per share. You can now break even at $70 per share rather than $90 per share. This is possible because the value of the $50 calls is now plus $20 compared to the minus $20 loss on your XYZ stock investment. As a result, you now have a zero net positions. Unfortunately, any move above $70 will necessitate selling your stock. You will, however, be up on the premium you earn from writing the calls and even on your losing stock positions if you sell it sooner than projected. Selling a strike price for the options is one of the most critical factors when implementing the repair technique. This price will influence your break-even point and determine if the trade is free. To begin, calculate the size of your unrealized loss on your stock positions. A stock purchased at $40 and now trading at $30 represent a $10 paper loss per share. The option strategy is often built by buying at the money options and writing out of the money calls with a strike price of half of the stock's loss. Start with the 3-month alternatives and work your way up to 1-year leaps if necessary. As a general rule, the higher the stock's loss, the longer it will take to repair it. In the ever-changing world of crypto, be sure to have a plan to be on top of the trend so that you can get the best out of every situation.